Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Carlos Hardenberg, manager of the Templeton Emerging Markets Investment Trust. Hello, Carlos.
Hello, good morning.
So a year in the job, and there have been significant changes in the investment trust from your predecessor, the most notable being that you have bought a considerable number of companies, the average holdings in the trust going from around 45 now up to sort of 90-something.
Yes.
What drove that decision to broaden out the trust?
So first of all, we wanted to make sure that we have a minimum degree of diversification in the trust overall. But more importantly, we try to make sure that we have the stocks in the portfolio that represent the opportunity of the future in emerging markets overall. So you have to be looking at technology. You cannot focus only on materials. You have to look at companies that innovate a lot. And you actually find them in more places than you would think. So it's not just Korea and Taiwan where you find innovative companies, but in many other places around the world. And therefore, we had to expand the scope of the portfolio.
Now, looking at the underlying holdings, the trust looks as if it's moved away from what one would traditionally call value stocks into sort of more growth-orientated stocks. However, you say it's not as simple as that, is it? It's not as simple as saying black and white, growth and value.
Yes, this differentiation is kind of very much focusing only on single factors. So low PEs, for example. People misunderstand a low PE with just being value and everything else can't be a value stock. So it really requires you to think more creatively and to understand the business models better, also within their competitive environment, in order for you to make an assessment of whether there is value compared to the operating environment, compared to the potential growth of the company, compared to the underlying value of the asset, and the value of the ideas of the managers that are working for those companies.
And how does that then show in the stock selection that you're making? Do you find yourself skewed towards certain sectors, or is it really that best-in-class sort of philosophy?
It really is kind of a best-in-class approach. So what we are ultimately trying to do, we've got a very experienced team of people in place in all kinds of different countries in the world. So we want to utilize that knowledge to our benefit. And the way you can do this is to be as close as possible to these companies, to the people that run these companies, the people that control these companies, and to ensure that you invest in the most innovative ones, the ones which are able to protect their business model against the competition, against disruption, and the ones that attract the best people for their businesses. So we do that by building relationships with these companies, by understanding them as good as possible. And I think that we've got a fairly unique and very experienced team that helps us to put together such a portfolio.
I think a bottom-up approach is admirable, but I sometimes think it can be a little naive to sort of say that the macro headwinds do not affect stock selection or indeed asset allocation. And there are quite a few around for emerging markets going into 2017.
Yes.
Not the least being that we have a new president of the United States who is unpredictable, to say the least. How do you balance those macro headwinds or challenges with this sort of bottom-up approach?
Yeah. So luckily, I'm not going to comment on politics too much because the only thing I'm going to say is that whenever politics gets really ugly, the greatest opportunities arise because markets always overreact. Look at Mexico, look at some of the currencies in 2015. There has been a massive overreaction, and that is where the opportunity then is. So whenever we talk to companies and we analyze companies in detail, we put them kind of under the magnifying glass, you cannot you cannot ignore the macroeconomic environment. You have to understand how a shift in currencies is affecting their earnings. How their capex ability is affected by certain macroeconomic regulatory issues. So we look at that quite a bit. We are very constructive and optimistic about emerging markets right now because we are seeing that these economies as a whole, they've done their homework. They've deleveraged. They have much better current accounts in place right now. They are faced with less volatility in the commodity markets, which have kind of normalized now. They're on healthy levels. And we're seeing, most importantly, that they've done their homework in moving away from maybe, the traditional plain vanilla business models, low-end, low-cost manufacturing, to a very high spot on the value chain where you have innovation brands. They have much bigger export markets now. They created market-leading products in many, many different industries, and they're based in emerging markets. So that's really where we see the biggest opportunity right now.
Thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.